Thanks for tuning into Talking Point. I'm your host, Niraj Shah. It's a bit of a truncated edition, but we'll try and get the best out of somebody who's a markets veteran, runs the equity portfolio at Bandhan AMC. Manish Gunwani needs no introduction. Manish, great having you. Thanks for taking the time out. Manish, at the outset, just trying to understand, is this market surprising you as well? Because it seems to be climbing every single wall of worry, be it local or be it global. I can count 7 instances in the last 9 months wherein everybody's called that this is a top, the markets correct a little bit and then tend to bounce back very, very smoothly.
Yeah, I think last 1 month in particular has been surprising, given that we had a correction in March based on regulator statements, and globally also, if you see the whole thesis of interest rates coming down globally, that has broadly gone for a toss. So the US 10-year yields are back to where they were probably 3-4 months back. See, we felt that the Indian macro, obviously, both on a relative sense versus other emerging markets, and in absolute terms, in terms of what has been happening to India's current account, which we felt was leading to Indian currency outperforming massively versus other currencies, this would lead to a liquidity flow, and which is why we've been relatively more constructive on small caps with a medium to long-term view. But yes, the pace of the last 1 month has been quite strong. And clearly, in terms of pockets of value, you're running out of ideas you can buy comfortably, right? So the other thing about this market is also that whatever's performing continues to perform, and whatever's not performing doesn't turn around, right? So whether it is power, real estate, capital markets, autos, that has continued to perform month after month, and IT, private banks, that is still struggling month after month. So the polarization in valuation is obviously increasing. Now you can obviously say that this is a cycle, and a lot of these segments had done badly for many years before this bull run. So yeah, it is a bit of a challenge now how to get ideas to put fresh money in. There's no doubt about that. But at the same time, we are seeing a lot of change across the world in terms of technology, in terms of policy. And I think you have to work hard to get those niches where you think India is heading, where the world is heading. Find those niches. They're not very big sectors which will grow very fast to my mind, which is why I think selectively small caps with a medium to long-term view is still where I think the alpha will be there. But yeah, the number of stocks that look attractive obviously going down as the market heats up.
Yeah, can imagine. I'm going to ask you where is India heading, as you said, but just before that, actually, let me start with that and then move on to the hot topic, which is telecom as well. But you mentioned that the idea to build the portfolio is to try and figure out where is the world heading and where is India heading. Where is India heading?
So India, I think, is obviously relatively very strong in terms of growth. I think, as I said, one of the key reasons for us to be positive relatively on the small cap space is the fact that India, after 30-40 years of running current account virtually to our mind, on a structural basis, is zero current account or may turn positive also in 3-4 years, hopefully. And that obviously will draw in a lot of capital from, it need not be only FI equity. So FI equity probably is one part. But you have debt, you have FDI, you have NRIs buying real estate, you have NRIs putting in fixed deposit or whatever. So there are various ways foreign capital will come in, which is clear. If you see RBI's forex reserves also have been very strong, given that dollars appreciated and US yields have gone up. So on a mark-to-market basis, the forex reserve should have not done well, but they've done well, which means their flows are quite strong. So my point is this, that One is India, I think, will get a lot of liquidity in medium to long term from the global capital pool. Second is that given our base, given whatever policies are there, we should continue to grow anywhere between 5.5 to 7.5. I don't think when global growth is going to be tepid, we can grow much beyond that. And our view is also that global growth is going to be tepid for the next 5-10 years, purely because of demographics and that. Now, in that scenario, India, because it is domestic driven, not very dependent on commodities, relatively will stand out. The other thing is, and again, this is specific to India in intensity, but I also think that it's probably happening globally, is that there is a reshoring that is happening in a lot of industries where countries, in terms of strategic industries like semiconductors or defense or various other manufacturing segments, it could be steel, it could be a lot of other things. Countries are trying to reduce their dependence on external supply chains. This is a kind of reversal again after 25, 30 years. So that is why I say that there is so much change, whether it's technology, whether these shifts in reshoring, shift away from China sourcing. So unlikely that a lot of these changes will be captured in very large companies.
Okay. And Manish, the other aspect is, from things that are becoming really hot, I want to also talk about something newsy, right? And telecom is firmly in the thick of things. I'm just trying to think of whether you believe, I mean, it's maybe not a very large sector, but large enough representation nevertheless. Do you think that the next 3, 4, 5 years will be different from what the preceding 5 years have been for telecom, which has largely been a two-player market with a third player struggling, to maybe now, because of this Vodafone NFO, or rather the Vodafone FPO rather, and success might make it a strong 2.5 player market, if you will?
Yeah, I think one is the number of players, and second is the pricing level, or let's say the profitability of the industry. What is the return on equity or operating margin it stabilizes at? I think the recent run-up in valuations is predicting that if the third player gets capitalized, it will not be just enough the external capital, but there needs to be a step shift in profitability of the industry, where there'll be a lot of tariff hikes, and the third player also may reach a point where it is stable. For that, I think you need significant pricing improvement in that industry. So I think investors are taking a bet that that pricing action will come through. I'm not neither very underweight nor overweight, because these are very, very difficult decisions to predict. Good part is in the current market context where valuations are high, it is a good defensive sector, that it is an essential item. No one's going to decrease its usage if economy turns down or if interest rates go up. So it is a defensive sector. Free cash flow yields if you assume these tariff hikes come through, are reasonably good. But again, it's not a high growth sector. I mean, every citizen in the country broadly has a phone in his or her hands, and therefore the penetration levels are high. So to me, it's not a very high conviction bet either way. I would hesitate to be very bullish or very bearish the sector at this point.
Got it. Okay. Manish, just one final question really before we take that break, and that is on this consensus, near consensus view around financials and growth and how economy grows. And then there are people who give me these opposing forces that bank credit growth or other capex need not be a correct determinant of bank credit growth, because a lot of companies which are doing capex are not necessarily going for that whole amount to banks the way they did in 2003-4. Just trying to understand, are you constructive financials, not just relative to the index weightage, but in general? I mean, if you had a choice, would you be grossly underweight financials?
Yeah, most of the banks, I am not so excited, or rather, I would say that need to see how this CASA thing plays out. See, one is the bank credit growth, and I'm also of the view that banking system is not a great play on capex, because if you see most of the banks today, especially the private banks, which are the big weights in the index, 60 to 65% book is retail, right? And even the other part, there's a lot of agri and SME and all that. So you're not going to play power or other kinds of capex through banks. And best part of credit cost is already priced in. So you can't take the view that, look, oh, I think the economy is going to do great. In a great economy, credit cost fall a lot because most of the companies or individuals are doing well. But the thing is, that is already priced in because the credit cost is at multi-decade low. So incrementally, you can't play banks for improvement in credit cost or as capex plays. What you need to see is, first of all, if you believe credit growth will accelerate up from 13-14%, which I don't see any reason why it will. And more importantly, I think you need to see CASA growth, because ultimately the reason you own a bank versus an NBFC is purely because of the deposit franchise. And right now, the jury is out whether you're seeing a cyclical slowdown in CASA because interest rates are high, so people are moving to term deposit rates, or stock markets are healthy, so people are putting money in SIPs and all that. But it could be structural as well, because at one level, CASA is inefficient money, right? I mean, you basically putting money in an account for transactions, which doesn't earn you much. Now, because of technology, because of financial literacy, if you believe that there is more efficiency in the system, because of which CASA is not going well, then I think there is no hurry to buy a lot of banks.
Got it. Okay. Manish, thanks for that update and really appreciate you giving us a sense of the market. Viewers, stay back. We'll be right back with Talking Point. Don't go anywhere.